Hello everyone, my name is Bukky. Welcome to my channel, your number one place where you learn about personal finance and career. And thank you for coming again. And so today I will be talking about investing for beginners. I will be sharing the very solid advice that you need to have in your pocket while you're thinking about your investment. As beginners, there are some things that you need to get right. And that's what I'm sharing with you today. There are principles that if you apply them, you have a higher possibility of becoming successful in this endeavor of investing. The thing about principle is that, or the thing about life is that it is what you give life that it gives back to you. And that is how principle works. And that is why the things I'm sharing with you today, they are gold mines that you should take very dear to heart and also apply them. Don't just listen to them and dump them into a place. No, don't do that. Don't do that to yourself. Rather, sit down, take your pen and paper, jot them down and apply them. It is really, really important. If you get it right, like I said, you'll be happy you listen to this video. Okay, without much ado, I would like us to just take a quick deep dive into the topic of today. All right, I'll be right back. Welcome back. Okay, so what's the first thing I'll be sharing with you today? The first thing or the first principle I'll be giving to you today is the principle of long-term perspective. When you are thinking about investing, don't approach it based on short-term basis. Don't approach it in such a way that, okay, I want to invest $100 now, and then in 2 or 3 months I want to get back $1,000. No, don't do that. Don't do it that way. Look at it in terms of, okay, I'm investing $100 now, but then I want to be able to gain back so amount in 10 years, in 5 years, or in 20 years, depending on how old you are. And that is the way you should approach investment. So for example, let's take a common form of investment, which is the stock market. Most people actually go into the stock market to say, okay, I just want to buy the stocks now. And once the price goes up, I would sell it off and cash in my money. Most times they end up burning themselves, like they end up like losing that money, and that's because they actually took a short-term approach into the stock market. Because you're not a trader, right? And even if you're a trader, remember that you are competing with companies that have the capacity, they have the money, they have the technology, they have the algorithms, they have the bots, they have the robots that could make fast decisions. Yeah, so they have all the heavyweights behind them that could make very fast decisions, and they are faster than you, and they have more money to throw around than you do. So those are the kind of people you're competing with when you look at investment on a short-term basis. And I know that you don't want to actually lose your money, so it's either you give them, the investment bankers, the money to help you invest, or if you want to do it yourself, do it yourself on a long-term basis. And that's why I said make sure you're looking at it on a long-term basis. Also, for example, when you look at investing on a short-term basis on real estate, right? You're not the developers, you're not the people that make all the research, all the things around the development within that short term. You are not an expert in that field. So it is actually difficult to like keep up always with the trends, right? So you want to, when you're also going into real estate, you're buying to hold, because then you're able to gain all the things that that market has for you at that point in time. So you want to look at it that way. And that's why I said it is really important that you look at your investment on a long-term basis. This is not what I just think. Of course, I've used it, but this is a principle that generals in the investment community are using, and it keeps working day in, day out. And that's my first: invest on a long-term basis. All right, the second thing I will tell you is don't invest based on emotions. What do I mean by that? Most of us have friends and families, and then all of a sudden there's this new investment thing going on around us, and they're telling us, okay, why are you not investing? Come and invest with me. Oh, let's invest together. And then when you say, okay, you know what, I don't think I want to do it now. I don't think I want to put my money in. And say, but you have the money. Like why are you hoarding the money? Like, it's the hot thing in the market now. It is really hot. It's the in thing, and because they're telling you that, your emotions start to get into play, and you'll be like, okay, you don't want to disappoint this friend of yours. You don't want to like feel like the black sheep in the family. I don't know if I'm speaking to someone, but I've had that same experience, right? So, and then you start feeling like, okay, you're the only one left out. It seems like every other person is cashing in, every other person is gaining something, and you're not gaining something. But when you look at it, your logic and your intuition is telling you, don't do it. But because of all the emotions, the euphoria around you, you then decide to do it. Anyway, I've also fallen a victim of investing based on emotions, and your guess is as good as mine. I never got my money back, but my capital, my interests, everything was just gone with the winds, because you know what? There was no underlying value in that investment. Okay, and that is my second thing I'll be telling you today. The third thing, which I already mentioned, is underlying value. So this is another strong advice I would give you, or another strong principle I would like to share with you. Again, if you're not taking anything out of this video today, make sure you are going away with this particular one. Do not invest in something that does not have any underlying value. What do I mean by underlying value? I mean that don't invest in something that doesn't have a product attached to it. Like there's nothing tangible that you can attach to that investment. So tangibility could be something like a physical product, it could be a digital product, it could be an assignment of stock and shares, that the tangibility means that your name is assigned to something, right? So a classical example of this tangibility comes in form of Ponzi scheme. Yes, Ponzi scheme, right? Or they tell you money flipping. Hello? There is no tangible thing behind, there's no tangible value behind it. And then you ask, okay, so for example, for the Ponzi scheme, they tell you pay so amount, pay $100, for example, into an account, and after 3 days call for help, and you get 30% or 50% of your investment back. And then you're like, okay, is it that the investment I'm going to put is it that what I'm putting my money to, is it a product, am I going to get a product or something? But they said no, some other people will just pay you, and you find out that there's nothing attached to that investment that you're putting your money into, and that is the underlying value. So do not invest in something that doesn't have any underlying value, that doesn't have a product, whether digital or physical, that your name is not assigned to. Don't do it, please. All right, the fourth thing I'll be sharing with you is start small. That is the fourth principle, right? Every big investor that you see out there, they started small. They started for somewhere, right? And the thing is, even if you suddenly fall into money, like you suddenly walk into money and you have so much huge amount of money, and don't first think of, okay, I'm going to invest in them. No, don't do that, because you cannot invest in something that you don't know. Don't invest blindly. Don't stumble into investment. When you stumble into investment, you will stumble out, because you will get burned. It's not a funny market. It's not a funny place. It's not a place to play, right? So don't stumble into it. And that's why it's important for you that you get it right, that you start from that small place that you are. Exactly. Start with the 50s, start with the 100s, start with the 1000s. Whatever your small is, start with that amount of money. Okay. And one thing about starting small is that if you start small, right, and peradventure you fail, you learn that, okay, this is not how I'm going to do it next time, right? And then you're able to quickly pick yourself up and forge ahead. But imagine you lose a chunk of money, which is for you huge. it recalls you, like it makes investment repulsive to you. You're not able to quickly forget it. And that's why it is really important, right? It's really important that you start small so that you can keep up the energy and keep up the pace and actually grow. All right, I hope that is really clear for you. Okay, now the fifth principle I'll be sharing with you: start early. What do I mean by starting early? If you are still a teenager, or you're in your 20s or your 30s, good for you. This is the time to start. And when you start, give it all the push you can afford. Give it all the push you can have. Because that is where the principle of compound interest comes into play in full force. I don't know if you've seen my video on compound interest. If you have not seen it, click on this link here. In that video, I gave an example of how compound interest can actually work for you in a over time, right? I made a very explicit example there. You will learn a lot on that video about compound interest. And if you're thinking, oh, I'm already 40, I'm already 50, I think it's too late. No, it's not too late. Some month ago, I met a woman who started a full investment in the stock market, I think at the age of 55 or close to 60, and she's now around 80. And she started then, I think, with just 20,000 euros or 30,000 euros. And now our portfolio is almost over 2 million euros. Wow. I was wowed. And then for me, it's like a push to say, you know what, it is never too late for anybody. All you need to do is have the money, sit down and strategize. Talk to people that have experiences and get going. Okay. And that's about starting early. Now, the sixth principle that I would like to share with you, and this is also one of my favorite principles, is that have a goal in mind. You cannot say that you want to invest and you don't know for what reason. So, because if you don't have a goal in mind, you would end up where you're not supposed to end up, because of course there is no goal. And life works on the principle of goals. Life responds to goals, because when you have a goal, then you have tasks tasks you must fulfill, and then you are able to work towards that goal. The same thing applies to investing. It is very, very important. Whether when you are constructing or coming up with your portfolio, have a particular goal in your mind. Envision what you want the end of your investment should be like. Are you investing towards retiring early, or are you investing towards putting that money someday into some business? Or what are you investing for? Are you investing towards being able to hand over something to your children or your grandchildren? Are you investing towards having a fabulous life sometime in the future? It's your choice. But whatever your choice is, make sure that you have a goal. And that is one of the main things that you have to get right while starting up as an investor. All right, I have two more I have two more advice that I'm going to share with you. But before I go ahead, if you have not liked this video by this time, please do. Also, don't forget to subscribe and click on the notification button, because whenever I post new videos, you get these new videos. And also, if you have any question that you want me to talk about, or you have any topic at all on personal finance and career that you would like me to pick up, do not hesitate to drop them in your comments. The more you engage with this video, the more YouTube pushes this video out there. Now, the seventh principle that I would like to give to you is that always have diversity at the back of your mind. This is very, very important, and that is one of the main ways you can actually avoid putting yourself at a lot of risk in investment. Yes, diversity is beautiful and diversity is strength, right? And why is that? When you diversify your portfolio, if one particular channel or one particular sector or arm of your investment is not doing well, at least you have one other part that is doing well. Diversity helps you not to put all your eggs, that saying that says don't put your eggs in one basket. Exactly. That is what diversity does for you. Diversity helps you not to put all your eggs in one basket. And then you can start thinking, okay, so what are the ways with which I can diversify my portfolio? I also made a video about the different ways you can actually invest in 2020. The link is right here, and then you can see the different ways I suggested that you can actually put your money and invest. But anyway, I will still mention them, and that's, you can, for example, you can invest in stocks, you can invest in fixed income, you can invest in exchange traded funds or index funds or mutual funds. You can invest in real estate, you can invest in another person's business, you can invest in some entrepreneurs, you can invest in venture, you can invest as a venture capitalist or as an angel investor. You can invest in crowd-funded projects. Yes, those kind of crowd-funded projects also gives you return. And so there's an array, right? A plethora of products or things that you can invest in. But make sure that you're not investing in one thing. Don't put all your eggs in one basket. Okay. The last thing, or the last advice I would give to you, is that be prepared for losses. I know you're not waiting or you're not expecting to hear this, but that is the truth. Like I said, the world of investment is up and down. It goes up and it goes down. You don't know where it goes to, because it's the market plane. There are so many people involved in the market, and the market swings wherever it goes, depending on what the people think the price of things should be. And that's why you have to be prepared for losses. And then you ask, but we are talking about investment here, and then investment should bring returns. So why should I be prepared for losses? Yes, I know that, but the reason why I said you should be prepared for losses is because it actually keeps you on the edge. It helps you with that small skepticism option, and that small skepticism option puts you on the edge to follow your money. So the thought that, oh, this thing might not do well, right, would help you to actually stay on the edge and follow that money and not just abandon your investment. And that is really, really important, because that is a very big problem for many beginner investor. They just buy things, yeah, I'm doing it for a long term, and they just abandon it. They don't follow it. No, don't do that to yourself. Don't do that, right? So be prepared for loss, and also be a little skeptical. When you're skeptical, right, you then know that, okay, I have to follow my money, I have to see how it's doing, I have to check on it, and that is how you can actually grow. All right, guys, I hope the things I've shared with you today, these principles that I've shared with you today, you would use them, you would apply them. You don't have to use everything, right? You can pick 2-3 things that you would want to apply. And I would also want to ask you before I go, is there any advice that you as an investor use to grow your investment? You are free to share with our community. We will be more than happy to hear what you have to say to this. And thank you for waiting to the end, and I hope to see you in my next video. Don't go away. Bye bye.